Morning, everybody. Great to see everybody. Great to see you, Stu. You seem far away.
I'm very far away, and I'm very excited to be here.
I'll lean in. Yeah, I heard you had a fun night last night.
There's a lot of drinks at Fintech Nexus.
Awesome. Well, anyone who doesn't know Stuart Sopp or Current, if you look at a list of the top 10 neobanks in the US, you will see Current on that list. They've got about 4.4 million users. And it's been in place for about 7 years. One thing that's interesting about your company is that you've pivoted a couple of times. I mean, I think you started out with this idea of decentralized finance and helping people with cryptocurrency. Could you tell us a little bit about where you started and how you've kind of pivoted a couple of times?
Yeah, it's a good question. Yeah, we were really early. I was into crypto. I was a former foreign exchange short-term interest rate trader for 16, 17 years in Wall Street banks based here in New York. And I saw Bitcoin 2011, so I was pretty early to that. And I guess this is a good learning lesson or a good lesson in general. Don't be too early to anything. You have time when it comes to innovation. And so I thought I was going to go and build this decentralized, bankless financial system that would be global, based not on banking rails, but on these new things called, on this new network called Bitcoin, and there was Ripple as well at the time. And I learned very quickly that, firstly, if you're explaining what something is to someone for most of the time, that is not a good sign that you're using something that is going to take off. And then secondly, when it comes to money, governments and regulators really care that it's on their system. So we backed it up a little bit, and we focused on building technology that was more traditional, but cloud-based and all the rest of it, and working with banks so that we're plugged into the banking system. And that, turns out, is the right way to do it.
So you started with DeFi, and then you got into teen banking. And you've been doing, and you're still doing that.
Yep.
And what would you say your main focus is on the current incarnation of Current? Like, how would you describe it in a nutshell?
Yeah, fintech in general has gone through an interesting period, right? So we've had this bull market generally fueled by the Fed for the last 12 years. And that has, has provided tailwinds in terms of investors taking risk. Innovators, entrepreneurs, and people in the startup community also trying to solve really tricky, complex problems because you have a long runway and there's lots of, I would say, somewhat cheap capital. And so we started 2015 in Current, and so we focus on banking people that don't fit the business model of banking, meaning we have conflated payments and credit into one banking experience, meaning that if you're living paycheck to paycheck, all of a sudden, we have a technology and a business model angle that enables us to profitably bank the many millions of people in America. So that's exciting. We're solving a real problem. But I would say, from a macro point of view, obviously given the really quick federal rate increases that we've seen, the cost of money has changed. And with the cost of money changing, fintech is literally finance and technology, right? We all know that. And so when it comes to the technology part, unprofitable tech in a rapidly rising interest rate environment, there is a focus on profitability, not growth. And so we've gone from sort of fifth gear to reverse on the growth to profitability. And then on the financial part, there's a lot of focus with the regional banks, and they've gone through their own thing, right? And so it's a really interesting year and a half where we've been buffeted by a bunch of forces in the macro market. What we have done is focused on what we can control, which is our own destiny, which is, it's not a slash and burn type company where you could, use a big incumbent where you fire 30%. For 50% of the company, and it's all good. We're still in the growth mode. And so for us, it's innovation. It's innovate out. It's provide more value. And I think specifically for us, that's where we are, and I think a lot of other fintechs are there too.
That's interesting. Yeah, I was going to ask you about the state of the industry and how there's been this drive toward having a path toward profitability. What would you say your path toward profitability looks like?
It's measured in a few quarters, not years. So I would also add, a year ago, maybe 2 years ago, this wasn't, no one talked about profitability for all the reasons I've just mentioned. And it's not because fintech doesn't want to be profitable. It's just that when the cost of capital was so low, it just made sense to reinvest that money and that focus back into growth. So it was growth at all costs. Yes, so path to profitability, I think the state of fintech in America specifically is in a more mature phase than many other countries. And there's lots of other keynote speakers and people have sort of hinted at that. And so what that means for us is path to profitability, scale matters, revenue scale matters, customer scale matters. And so it's like, how are we going to get to that as quickly as possible? There's going to be a lot of M&As in the market, and there's going to be a lot of innovation and a lot of focus on unit economics. Unit economics was sort of almost swearing 2 or 3 years ago, right? It's like growth at all costs, but with the profitability focus, unit economics are really, really important. That's really what drives the financial side of this business.
So a lot of people are looking to lending. A lot of neobanks are looking to some kind of lending to bring in more revenue and drive profitability up. Is that kind of where you're going?
Yeah, from a product perspective, I think the deposit wars, if I can term it that way, we've got Chime, we've got Varo, we've got Current, you've got Cash App, and many others, to be honest. And everyone's gone out for the deposits and the conflation of banking that I've just mentioned. The next wave, when you talk about unit economics and you talk about profitability, you really have to get into lending. Now, there's a bunch of different ways you can do that. We are personally going into credit building, which I'm more than happy to talk about. I think that's a good first step. But many other people, many other companies are dealing with this in a different way. You see unsecured, revolving. You see, we've seen the BNPL wave. And so lending traditionally is how you monetize banking. We all know this is a long duration game if you have a banking license, but it has its own problems as well, right? And so we're watching carefully around that.
So a lot of the current neobanks that have some kind of credit builder have, there's a little bit of criticism around that where people say these programs are really prepaid debit cards where you're really just you're letting people put some money in a separate account and then they can use a card to access that account, and that doesn't really prove their ability to repay. What do you say to that?
Yeah, I think that for that product, it's absolutely true. I think the barriers to traditional credit building, it's a great innovation when it came out, to be honest. But here we are in 2023. And I think when you look at like putting away, for the majority of people that need to build their credit in a sort of safe way, they don't really have that $300 or $500 to put away. They actually need that money. And so it doesn't work for the majority of people. Also, banks don't like to market this product that much. Credit unions slightly different, but banks don't like to market this product because it sort of cannibalizes everything else. And the FICO band for that product that you just mentioned is very, very narrow. So it kind of doesn't work for them. From our point of view, this is the innovation, the tech stack that we've built over 7-8 years now. We actually process ourselves directly with Visa Forward as well, the only US client on Visa with that. And so we have margin expansion. We sort of control our own destiny on that. And with that technology, owning the ledger of record and all this other microservices around money movement, it has enabled us to innovate around a debit and a credit bin. And so from a consumer standpoint for our product, by the way, this product's not launched yet, so don't tell anyone. My head of product and my exec team is going to kill me. So we launch in a few weeks. And so the innovation that we have done, which I won't go too much into because it's our secret sauce, is that from a consumer point of view, they have one balance. And so when they swipe their debit or their credit building card, it deprecates one balance for them. And then in terms of putting away money, we hold those funds aside as it comes in, and so they don't need to pony up for an attach rate to a separate card that then builds it. So for all intents and purposes, from a consumer point of view, this is a credit building product that works just like a checking account, and it's very simple for them to use, and they can use it in and out with their other debit card if they don't want to impact their credit. Now, some people in the audience or some people may go, well, where's the credit? The credit is around the bill pay, the payment of that bill, and also the deposit, making sure the deposit settles. And so making sure so every 15 days they have to pay that bill off. And so, yes, you can elect into auto pay just like every other credit builder, but many other people will be manual and other people will want to sweep it before that time. And so we're really excited about this product. We think it's a game changer. We don't think we're going to have the same problems in attach rates that many, many other fintechs and banks have with this product. And we think most importantly, it's going to help millions of Americans at a time of need, high inflation, build their credit.
So another interesting thing about Current is you guys do a lot of interesting things with digital marketing. And I think, because not every neobank gets to 4 million customers. So
yeah.
I've tried to think about what is the key, what is your secret sauce here? And I think some of it is digital marketing. And one of the things you do is you work with a lot of influencers. Can you tell us about some of your, maybe most well-known influencers, and how do you decide who you're going to allow to represent or, encourage to represent your brand?
Yeah, it's a great question. So we're a digital bank, right? Banking service. Sorry, we're not a bank. We're providing banking services. A digital financial platform providing banking services. And so for us, whereas a bank would have physical real estate branches, we have digital real estate, and that's really important. And when you talk about a younger consumer, 18 to 30, let's call it, the way they consume content and what channels where their attention is very different to, say, a 35 to 50-year-old, right? Things have changed. We spotted this maybe 4 years ago now. And so we went sort of quite heavy on YouTube influencers, TikTok and Snapchat. So those of you with kids in the audience will know all about those things. And so TikTok, we're the biggest financial brand on TikTok. Geopolitics aside, that's been very good for us. And then Snapchat's obviously a great middle ground, but they need some more work on their ad platform, if you ask me. And then YouTube influencers really doubled down on that. So we were the first really financial brand to go out and sign up a bunch of influencers. So Jimmy Donaldson, Mr. Beast, he is now the biggest YouTuber in the world, right? And so if you see his content, it's phenomenal. It's very high production. It's very costly. And he has phenomenal attention and engagement with an 18 to, let's call it 24, 26-year-old. When you talk about the brand and the brand risk, we talk about that in our discussions, right? So we signed him a few years ago now, like 2 or 3 years ago. Our head of marketing actually gave him his first $10,000. And so at a different company. And so there was a relationship there, Adam Haddy there. And so we really sort of doubled down on this. And the reason why we did it was, when it comes to financial brands and financial products in general, this is my view, but I think it could be proven, is that trust is really important, as we all know, but you can't sell your product. People need to sell your product. It's referrals, it's organic. You hear this all the time, right? And just think about your own experiences when you're like, oh, I need to get this, that, the other in terms of financial products. You do ask your friends. You ask your smarter friend or your more adept friend. And so it's just very obvious when it comes to a high bar or high barrier to trust, you need a trusted individual to help sell and help convince people of your products. And Mr. Beast for this demographic is literally the best person, the most trusted person out there. And so we talk about that in the negotiations when we sign these contracts. We talk about brand reputation and risk. And I was talking to Penny a few days ago, and I was like, yeah, it's sometimes scary. We have not been perfect, right? We have made mistakes. And so when you talk about individuals, I'll give you an example, like Cap One, right? They have Morgan Freeman and all these other celebrities. That's risk for them. But they've learned the same lessons as we've learned, or we've learned the same lessons as them, maybe. That you need trusted individuals with long-form content on trusted channels to try and scale and approach that trust barrier.
As you talk, it's clear to me that I'm not in your target demographic. But,
not yet.
But were you guys affected by this recent banking mini crisis, some people are calling it, and is it an opportunity for companies like yours?
Yeah, another great question. We're affected in the sense that we had some money at SVB that was in a money market fund or whatever, and so we were, like all tech firms, I think 90% of tech firms had some form of money there. So that was distracting, operationally distracting. It was like a 7-ladder fire alarm for 4 days, and I'm sure even worse for the U.S. government and regulators, right? And so destabilizing. Just trying to work out, to do the right thing, right? So we're affected in that way. I think as we went from a liquidity, you can tell I'm a ex-macro trader, we went from a liquidity crisis to a solvency, right? Profitability, solvency. It's like, okay, SVB and a few of these others have either commercial real estate or they YOLO'd, treasuries at the highs or whatever it is, right? They've obviously lost a lot of money if you start mark-to-marking these long duration assets. And so I think, just generally, I don't think it's systemic. I think there's just gonna be more of this coming along as we're higher for longer in interest rates. And so, we're looking at, I think for the first time ever, we're looking at our partner banks and their balance sheets. It's normally the reverse. So we're in this part of third-party due diligence, just making sure that we've got risks spread and things are so that we can promote and be on the front foot going forward. I think from a banking crisis, I just don't see it. I see it's because I think the banking industry is really strong since 2008, and I do think that there is other problems in the market that are maybe not banking related specifically, but they may hold some of those assets.
So some analysts have estimated that there are around 400 neobanks in the world, and that a lot of them are going to go out of business, like 90%. What do you think? What do you think of that kind of prediction? And what do you think are some of the critical things needed to survive? Is it the right leaders? Is it the right team? Is it the right technology? Is it the right products? Is it the right brand? The right marketing? It's two questions really. But.
Yeah, I think just on the first part, I guess, I don't really have an opinion on 90% going under. I think investors and talking heads in general, they get very bullish at the high and they get very bearish at the low. So, so I'm like, okay, everyone was winning 2 years ago, now no one's winning. So I think there's something like more medium, more measured in the middle. And I think, yes, there will be consolidation. That's definitely going to happen in my view. But I don't think, I'll put it more positively. This digital wave is not going away. Right, it's just happening, and yes, there is a breath, a pause, and a focus on profitability, which I think is healthy. There's a focus on regulation. There's a focus on compliance. These are good things, but that if you're an incumbent, the ones that are coming through this are going to be really strong, right? You can't really poke too many of those bears anymore because they're fixing the problems and they're being forced to fix those problems. And if they start rolling up, they start getting to profitability quicker and to a scale that starts encroaching on maybe in the incumbent models. So I think that's what's going to happen. I think the US is more of a mature market. I think that the compliance and regulatory overhead, it's much harder to start a fintech than ever before. So I feel sorry for the seed and Series A's. They may get funded, but I think they're going to struggle a little bit. It's going to be hard for them. And then externally, Latin America, MENA, or some of the more developing nations, I think there's more sort of early growth opportunity there, but then you have more fraud, and then you have more risks around that, right? And then you have currency risk, so all those things. And then if I was to take the second part of the question, what does it take to do this? I think you need to have a sense of urgency. You have to understand that the conditions have changed. You have to make decisions really, really quickly. You're already hardworking, right? So you're in a startup. You're in this thing that's really complicated and has lots of regulation and there's lots of rules, and you're trying to, and banking's been around forever. So, there's very small gaps that you can get into. So you're really trying to push hard on those gaps and then expand out. And so you've got a highly dedicated, highly motivated team, but now they have to work 20% harder. They're already working 110%. So there's the burnout risk, and then there's, innovate out the products. You've just got to do more, better unit economics. You've got to be more targeted when the targeting of marketing has changed since Apple Facebook privacy case. And so you've got all these macro forces, the washing machine, just moving us around, calm head, know where you're going on in terms of your mission, motivate your team, get the money if you need it, and then really focus on those unit economics. I think that's really what's going to happen. Know where you are as well, I would say. Know where you are as a company and the macro environment.
That makes sense. So I guess really last thing, there was a speaker this morning from Marqeta who talked about the challenges of growing as a fintech. Where you get to a certain point, you need more structure, you need more, I forget the exact words, he talked about needing more structure, needing to scale up. Are you kind of at that point where you're having to do that too?
Yeah, that's crazy because we actually hit that last year, and so I now know, because I've lived it. I now know what everyone's talking about. So if I was to give you a TLDR, it's like when you grow a startup, it tends to be a very flat, very flat organization, meritocracy, and then you have sort of one person for every job. And then as you scale and you get more people, you just assume that they're doing the same things as you would have done them. Because there's no docs, there's no, we do on-the-job training and all that stuff. And so you go from 40 people to, say, 200 people, you 4 or 5x it. What you realize is there's a lot of inefficiencies, and there's a lot of people saying, I don't know what to do. I don't know what I'm meant to do. I don't know what I'm really responsible for. And so we actually reorged our company. It took us 4 months, actually, to do it right. And it's still not perfect, but I feel really, really good about where it is. And I think from this point, we can scale to the next 2 or 3 years pretty easily. But it's something that is not really well talked about, and it's hard to do.
It creeps up on you, I'm
Yeah,
sure.
it really does. And you notice it in just the productivity and the results. You don't ship product for a year, and you're like, what's going on?
All right, well, I'm afraid we're out of time, but Stuart Sopp, thanks so much for your time.
Thank you, Penny. It's great to be here. Thank you.